Iraq's foreign currency reserves remain one of the most closely watched indicators by Iraqi Dinar investors around the world, and recent figures, placing those reserves at over 100 billion US dollars, continue to draw serious attention. These reserves are held by the Central Bank of Iraq and are composed primarily of US dollars, gold holdings, and select foreign assets. For investors, reserves of this size are not merely symbolic. They represent the central bank's ability to actively manage monetary stability rather than react defensively to market pressure. Iraq's reserve position is closely linked to sustained oil export revenues, which continue to generate large inflows of US dollars into the national financial system. These inflows allow the central bank to cover import financing, support government obligations, and stabilize currency demand during periods of stress. In practical terms, reserves of this magnitude allow Iraq to maintain confidence in its currency framework even when global markets experience volatility, oil prices fluctuate, or regional conditions become uncertain. Many economies with far fewer reserves struggle to defend their currencies during economic shocks, often resulting in rapid devaluation and inflation. Iraq's reserve strength sharply reduces that risk profile. It provides policymakers with room to maneuver, delay abrupt decisions, and implement reforms without destabilizing the dinar. For long-term investors, this matters because currency value is not driven by rumors or expectations alone, but by institutional capacity. The existence of large reserves signals that Iraq can meet external obligations, supply foreign currency when required, and prevent disorderly currency movements. While reserves do not automatically translate into appreciation, they significantly lower systemic risk and reinforce the credibility of the monetary authority. This reserve position places Iraq in a stronger comparative position than many emerging markets and supports a narrative of financial resilience rather than fragility. For dinar investors listening globally, this is a foundational fact that underpins all future analysis. The Iraqi dinar continues to operate within a managed exchange rate framework that reflects deliberate monetary policy rather than uncontrolled market forces. The exchange rate, commonly referenced near 300 Iraqi dinars per $1 US dollar, has remained relatively stable due to consistent intervention by the Central Bank of Iraq and the availability of substantial foreign currency reserves. Iraq's economy relies heavily on imports, including food, medical supplies, consumer goods, and industrial equipment, all of which require access to US dollars. When demand for dollars increases, particularly during periods of higher import activity or regional uncertainty, the central bank uses its reserve capacity to supply foreign currency through official channels. This process reduces pressure on the dinar and helps prevent sudden depreciation that could trigger inflation and disrupt domestic pricing. Maintaining currency stability is essential for economic planning, wage payments, and government budgeting. A stable exchange rate allows the Iraqi government to manage public sector salaries and subsidies without sudden cost increases. It also provides businesses with greater predictability when pricing goods and negotiating contracts. In countries where reserves are insufficient, even small shocks can lead to rapid currency declines and loss of confidence. Iraq's reserve strength significantly lowers that risk by giving policymakers the tools needed to manage market expectations and discourage excessive speculation. The central bank's ability to intervene reinforces confidence among businesses and consumers, reducing the likelihood of panic-driven demand for foreign currency. From an investor standpoint, exchange rate stability does not mean stagnation. It reflects a controlled environment in which gradual reforms can take place. Central banks typically avoid abrupt currency movements because they can harm trade competitiveness and create uncertainty across the economy. Iraq's current approach prioritizes balance, ensuring that import costs remain manageable while inflation pressures are contained. Reserve-backed intervention allows the dinar to function as a medium of exchange rather than a speculative instrument. This is particularly important as Iraq continues to strengthen banking oversight, improve compliance standards, and modernize payment systems. For Iraqi dinar investors worldwide, the key implication is reduced short-term volatility. While long-term outcomes depend on broader economic reforms, Reserve-supported exchange rate management provides a stable platform for policy development. Investors are encouraged to monitor official policy actions, reserve trends, and institutional reforms rather than reacting to rumors or short-term market noise. Stability supported by strong reserves remains a defining feature of the current dinar environment. From an international standpoint, Iraq's foreign currency reserve position plays a central role in shaping how the country is viewed by global financial institutions, correspondent banks, and trade partners. Reserves reported at over $100 billion send a clear signal that Iraq has the liquidity needed to support cross-border transactions and meet external obligations. In global finance, reserve strength is often interpreted as a measure of a country's ability to withstand economic stress without resorting to emergency monetary actions. For Iraq, this perception is particularly important as the country continues to rebuild trust in its financial system after years of instability. Strong reserves support smoother international trade by reducing settlement risk for foreign counterparties. When banks and exporters engage with a country that holds adequate reserves, they are more confident that payments will be honored in currency, disruptions will be limited. This confidence encourages trade flows and helps integrate the country more deeply into global financial networks. For the Iraqi dinar, this reduces systemic risk and reinforces stability, as international actors are less likely to demand restrictive terms or avoid transactions altogether. Reserve strength also supports Iraq's engagement with international financial standards. As the banking sector undergoes reforms aimed at improving transparency, compliance, and oversight, reserves provide a stabilizing buffer that allows these changes to be implemented without destabilizing the currency. In many cases, financial modernization requires tighter controls, which can temporarily reduce liquidity or expose inefficiencies. Countries with weak reserves often struggle during this transition. Iraq's reserve position allows reforms to proceed more gradually, minimizing disruption while maintaining confidence in the dinar. Another important consideration for investors is that reserve adequacy reduces the likelihood of forced policy responses. When countries face balance of payments pressure without sufficient reserves, they are often compelled to devalue their currency sharply or impose capital controls. Iraq's reserve buffer lowers the probability of such outcomes and supports a more predictable policy environment. This predictability is valuable for investors seeking to assess long-term risk rather than short-term speculation. For Iraqi dinar investors worldwide, the international dimension of reserve strength reinforces the importance of fundamentals. While exchange rates may fluctuate within a managed framework, the presence of substantial reserves strengthens Iraq's ability to maintain order and credibility in its monetary system. Investors are advised to track reserve trends, trade performance, and institutional developments as primary indicators of currency health. For investors, it is important to clearly distinguish between reserve strength and expectations of immediate currency appreciation. Large foreign currency reserves provide protection and flexibility, but they do not automatically result in sudden changes to an exchange rate. In fact, central banks with strong reserves often choose stability over rapid movement, especially in economies that are still strengthening institutional frameworks. Iraq's current monetary approach reflects this principle. The exchange rate, commonly referenced near 1,300 Iraqi dinars per US dollar, has been maintained to support economic planning, inflation control, and fiscal stability rather than speculative gains. Sudden currency adjustments can create significant disruptions across an economy. A sharp appreciation could negatively impact government revenue calculations, distort import and export pricing, and introduce uncertainty for businesses and consumers. For this reason, Iraq's monetary authorities prioritize balance and predictability. Reserve strength allows the Central Bank of Iraq to absorb external shocks, such as fluctuations in oil prices or temporary changes in global financial conditions, without being forced into abrupt policy decisions. This capacity reduces the likelihood of crisis-driven measures that often occur in countries with limited reserves. Another key role of reserves is risk management. By maintaining a substantial buffer, Iraq lowers the probability of forced devaluation or emergency capital controls. Investors often underestimate how frequently currencies weaken due to reserve exhaustion rather than economic fundamentals. Iraq's reserve position provides time and flexibility, enabling policymakers to respond methodically rather than react impulsively. This environment supports gradual reform, which is typically more sustainable than rapid structural change. For Iraqi dinar investors, the presence of strong reserves suggests that future developments are more likely to be policy-driven and deliberate. Currency reforms, if pursued, are usually implemented after financial systems are strengthened and compliance mechanisms are improved. Reserves support this sequencing by maintaining stability while reforms take place. This approach aligns with international best practices and reduces systemic risk. Ultimately, reserve strength improves the quality of the monetary environment without guaranteeing specific outcomes. Investors should view reserves as a stabilizing force that supports long-term planning rather than a trigger for immediate currency revaluation. Monitoring policy signals, institutional progress, and reserve trends remains essential. Stability backed by reserves positions Iraq to manage its currency with control and credibility, reinforcing a measured outlook for the Iraqi dinar. For Iraqi dinar investors across the world, the most important takeaway is that Iraq's foreign currency reserves represent strength and capacity, not speculation. Reserves reported at over $100 billion provide the Central Bank of Iraq with the ability to manage liquidity, stabilize currency demand, and maintain confidence during periods of global or regional uncertainty. This reserve foundation supports the current, managed exchange rate environment and reduces the risk of disorderly currency movements that can damage long-term investment confidence. In practical terms, reserves allow the monetary authority to act proactively rather than reactively, which is a critical distinction in currency management. A reserve-backed monetary framework also improves the overall quality of economic decision-making. When policymakers are not under immediate pressure from currency instability, they can focus on longer-term goals such as banking reform, financial transparency, and institutional strengthening. These elements are essential for sustainable economic development and play a direct role in shaping the future. Behavior of the dinar. Investors should understand that currency stability is often a prerequisite for reform, not the result of it. Iraq's reserve position supports this sequencing by ensuring that reforms can be implemented without destabilizing the exchange rate. From a risk perspective, strong reserves lower the probability of sudden, negative outcomes such as forced devaluation, uncontrolled inflation, or restrictive capital measures. While no economy is immune to external shocks, reserve adequacy provides a buffer that absorbs pressure and limits spillover effects. For long-term investors, this reduces uncertainty and supports a more measured assessment of risk. It also reinforces the importance of monitoring fundamentals rather than reacting to short-term market noise or unverified claims. The exchange rate, commonly referenced near 1,300 Iraqi dinars per US dollar, reflects a policy choice supported by reserves and institutional oversight. While future adjustments cannot be predicted with certainty, any changes are more likely to occur within a controlled and deliberate framework rather than through sudden market-driven events. This controlled approach aligns with how central banks in reserve-rich economies typically operate. In conclusion, Iraq's foreign currency reserves serve as a central pillar of its monetary system. They underpin stability, support confidence, and provide flexibility in policy execution. For Iraqi dinar investors worldwide, the focus should remain on reserve trends, official policy signals, and institutional progress. These factors offer the clearest insight into the currency's outlook. Stability supported by strong reserves does not promise immediate gains, but it does create a foundation for orderly development and long-term credibility in the Iraqi dinar.